Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way. Today, we are looking at what I can only describe as a massive illusion.
Oh, absolutely. The numbers we're seeing are wild.
Right. I mean, if you've glanced at any financial news this week, you've probably seen these apocalyptic headlines screaming that China's oil demand just evaporated by a staggering 4.6 million barrels a day.
Yeah, evaporated is the word they love to use.
Exactly. And, the immediate picture that paints is just this collapsed economy, right? Like abandoned cars on the highways, factories sitting completely dark, just totally stalled out.
The panic makes sense, on the surface at least. I mean, when a number like 4.6 million barrels just vanishes from the global ledger overnight, your knee-jerk reaction is to assume the engine of global growth is broken.
Right.
But if we actually look under the hood at the recent analysis, the reality is it's actually far more dangerous for legacy oil producers. China hasn't stopped growing. They've just, stopped needing as much traditional oil to do it.
Which is really the core mission of our deep dive today, because we aren't looking at a simple case of consumers just deciding to stay home and drive less.
No, not at all.
Based on recent analysis, we are tracking a fundamental rewiring of the global energy market. And there are 4 distinct structural shifts happening right now, covering exports, electric vehicles, plastics, and a totally new price sensitivity.
Yeah, and if you are an investor trying to navigate this landscape, understanding how these shifts impact your portfolio is absolutely critical.
Exactly. So to start, we have to separate actual on-the-ground consumer demand from the behind-the-scenes industrial adjustments, right?
Right, because people conflate the raw crude oil a country imports with the gasoline its citizens actually pump into their cars. And in China's case, those are 2 entirely different metrics.
Completely
Yeah, and confusing them is what leads to terrible investment decisions.
Okay, let's unpack this. Because if domestic oil demand isn't the whole story, we need to look at the factories that make the gas, right? The refineries.
Exactly.
I mean, for years, the narrative was that China imported raw crude simply to fuel its own massive internal growth. But based on the data, a huge chunk of that oil wasn't even staying in the country.
It wasn't. Chinese oil refineries had built this massive, lucrative business model, acting as the processing plant for, the rest of Asia.
Oh, wow. So they were basically the middleman.
Exactly. They would import vast quantities of raw crude oil, refine it into usable products, diesel, gasoline, aviation fuel, and then export the surplus to neighboring countries at a premium.
So tracking their raw crude imports historically gave a highly inflated view of what the everyday Chinese consumer was actually using.
Precisely.
Okay, think about it like this. If a town bakery suddenly buys half as much flour as they usually do, your first instinct is that people in town just stopped eating bread, right?
Right, which makes sense.
Yeah. But what if the government just told the bakery they aren't allowed to sell cakes to the neighboring towns anymore? They don't need as much flour because their export territory just got shut down.
That is exactly what's happening. Following the fallout from the 2026 Middle East war, Beijing got incredibly protective of its own domestic energy security.
So they basically choked off the refinery's ability to export those products.
They forced a hard pivot. Yeah, Beijing paused new fuel export contracts back in March, and that restrictive posture carried right through the spring and early summer.
And we can see that in the data, right?
Oh, absolutely. When we look at the May 2026 numbers, China's raw crude oil imports plummeted to an 8-year low of just 7.79 million barrels a day. The volume of oil the refineries actually processed just fell off a cliff. It dropped by 2.29 million barrels a day.
But wait, how does a refinery just stop processing? I mean, don't they have massive fixed costs? It seems like shutting down operations would be, financial suicide.
Well, operating at a massive loss is the worst alternative.
Fair point.
We have to look at the independent refineries in Shandong. The market relies on them heavily, and they're often called teapots.
Teapots, okay?
Yeah. These independent operators buy raw crude at global market prices. But because Beijing severed their export market, they are forced to sell their refined products domestically.
Where the market is already totally saturated, right?
Saturated, and prices are strictly capped by the government. Recent analysis shows these teapots are losing roughly 752 yuan, which is about $111 for every single ton of imported crude they process.
Wow. So the business model is just completely broken. If the raw material is expensive and you are legally barred from selling your finished product to the high-paying international markets, you You just stop buying the raw material.
You turn off the machines. You have to.
That makes total sense. The demand didn't vanish. The profitable export margin business model broke.
Exactly. That single policy shift accounts for a massive portion of this so-called evaporated demand.
Okay, so that explains the industrial side, the bakery analogy. But domestic oil demand is capping out on the roads too, right?
It is, yeah.
And here's where it gets really interesting, because usually standard economic rules say that when a country's middle class grows, people buy more cars and gas demand just skyrockets.
Right, the classic U.S. and European playbook.
Exactly. And according to the research, China is still buying millions of cars. So why on earth is Sinopec, which is one of China's own state-owned oil giants, predicting a 10% drop in gasoline and diesel demand for Q2 and Q3 of 2026?
Well, what's fascinating here is the sheer velocity of China's electric vehicle and plug-in hybrid adoption. It's completely breaking that old formula.
Because they're the biggest market for both, right?
Yes, China is living a dual reality. They are simultaneously the world's largest legacy oil importer and the undisputed center of the global EV market.
And the International Energy Agency's 2026 Global EV Outlook essentially proves this. Based on their data, EVs already replaced about 1 million barrels a day of oil demand back in 2025.
Yeah, and that displacement is on track to scale to 2.7 million barrels a day by 2030.
But what I find so interesting is where that displacement is happening. It's not just, an upper-class family buying a Tesla for weekend errands.
No, the real devastation to oil demand is happening in the commercial sector.
Yeah.
We're talking high-mileage vehicles. Think about taxis, the massive fleets of rideshare vehicles similar to Uber, and the endless stream of local delivery trucks in these megacities.
The math on that is staggering. I mean, a personal car might be driven, 10 or 12,000 miles a year, and it spends 90% of its life parked in a driveway.
Exactly. But a commercial rideshare vehicle, that's on the road 14 hours a day. It's racking up 70,000 miles a year.
70,000 miles. So electrifying just one of those taxis destroys the gasoline demand of half a dozen personal cars.
Right. And because electricity is significantly cheaper than gasoline, these fleet operators are highly motivated to switch to batteries, purely to cut their daily operating costs.
It's just smart business.
Exactly. The crucial takeaway for anyone listening to this deep dive is that automobile growth no longer equals oil growth. That century-old formula is permanently broken.
So even if the Chinese market absorbs 10 million new vehicles next year, if the vast majority are plugging into a wall, the global oil market doesn't feel it at all.
Not even a ripple.
Okay, so we've solved the transportation piece, but cars aren't the only things that require oil. What about the petrochemical industry?
Yes.
Because every day, plastics, packaging, medical supplies, they all rely on this stuff too. Are they applying that same ruthless cost-cutting logic over there?
They absolutely are. Petrochemicals are actually the silent giant of global oil consumption. And the exact same economic survival instincts are rewiring that sector right now.
So how does that work?
Well, to understand this, we need to look at a substance called naphtha.
Naphtha, okay.
Naphtha is a derivative of raw crude oil. And for decades, it's been the foundational building block for manufacturing ethylene and propylene, which eventually become the plastics we use every single day.
Okay, so it's the primary ingredient. Let me bring this to the kitchen table for a second. If butter gets insanely expensive because of some supply chain issue, I'm going to bake my cookies with vegetable oil instead, right? I'm not going to stop baking. I'm just swapping the recipe. Looking at the data, Chinese chemical companies are doing the exact same thing.
That is a perfect parallel, yes. Naphtha is the butter of the plastics world, and the 2026 conflict involving Iran and the subsequent closure of the Strait of Hormuz acted as that massive supply shock.
Oh, so the price of the butter just skyrocketed.
Exactly. The premium that Asian manufacturers had to pay for naphtha over the standard price of Brent crude shot from around 108 times a ton to well over $400 a ton.
Wow, over 400?
Yeah, it completely vaporized the profit margins of these massive Chinese plastics hubs.
So just like me switching to vegetable oil to survive a butter shortage, these factories aggressively swapped out their raw material. But what's wild is where they turned for the replacement.
Right. They bypassed the Middle East entirely and started pulling massive resources from the United States. They pivoted to American ethane.
Ethane. Okay, and that's different from naphtha.
Very different. Ethane is a natural gas liquid. It's extracted as a byproduct of natural gas production in the U.S., not from drilling for crude oil.
Got it.
Because of the geopolitical chaos in the Middle East, Chinese manufacturers realized that relying on oil-based naphtha was a massive liability. They needed a cheaper, far more stable input.
And the U.S. had it.
Exactly.
Yeah.
As a result, May 2026 saw absolute record volumes of U.S. ethane loaded onto specialized ships in the Gulf Coast and sent straight across the Pacific to feed Chinese chemical plants.
The irony there is incredible. A geopolitical conflict in the Middle East essentially forces China to underwrite the expansion of United States natural gas infrastructure just so they can keep making plastic packaging.
Yep. If we connect this to the bigger picture, every ton of plastic manufactured using American ethane is a ton of plastic that didn't require a single drop of Middle Eastern crude oil.
And that transition is semi-permanent, right? I mean, once a multi-billion-dollar chemical plant retools to process ethane, they don't just switch back the moment oil prices dip a little.
No, absolutely not. They have fundamentally shifted their long-term demand directly away from global crude oil and into U.S. natural gas infrastructure.
Wow. Which brings us to really the most critical shift of all. Because for 2 decades, China was the market's ultimate inelastic buyer.
But they were the buyer of last resort.
Right. They would pay any price, pay whatever premium was required just to keep growing. But by swapping ingredients and switching to electric cars, China has fundamentally changed its relationship with the global oil market. So what does this all mean for the broader market? Are they finally putting their foot down?
They really are. The transformation is profound. China has transitioned from a desperate, inelastic buyer into a highly strategic, price-sensitive major adjuster.
Major adjuster.
Yeah. In the past, if a supply shock hit, like the Hormuz closure we just discussed, China would panic buy. They'd hoard resources to ensure their economy didn't stall, which would send global prices into the stratosphere.
But the May 2026 figures tell a completely different story.
They do. Despite that massive drop in imports, they only pulled about 500,000 barrels a day from their strategic inventory to bridge the gap.
Which is tiny compared to what they used to do.
Exactly. They simply chose to reduce operations rather than overpay during a supply shock. They looked at the inflated prices and said, no, we'll just buy less.
And as an investor, you have to realize that this new behavior actually saved the global market.
Oh, it absolutely did.
I mean, think about the Hormuz supply shock. If China had kept buying blindly at any cost, oil prices would have absolutely exploded. We would have been looking at, what, $150 or $200 a barrel?
Easily. And that would have triggered crushing inflation and a likely global recession. But weak Chinese demand acted as a massive buffer against that supply shock. By stepping back, they kept global prices from spiraling out of control.
Okay, let's bring this all together for the listener. Because according to the analysis, the money isn't disappearing, it's just moving. If China is no longer the ultimate growth engine for crude oil, where does an everyday investor look next?
Well, we are currently witnessing a massive debate between the world's biggest energy forecasters over this exact question.
The IEA versus OPEC, right?
Exactly. On one side, you have the International Energy Agency. They see the EV adoption, the ethane substitution, and China's new price discipline, and they project that global oil demand will plateau around 2030.
So the era of perpetual growth is just over.
In their model, yes. But then you have OPEC. OPEC sees endless uninterrupted oil demand growth all the way out to 2050.
Wait, how can they possibly justify that when their single biggest customer is actively engineering oil out of their supply chain today?
It's a huge gamble. They're basically banking on places like India to pick up all that slack. But the data heavily favors the IEA right now. In fact, current models suggest a massive 5.05 million barrel per day supply surplus by 2027.
5 million barrels a day of excess inventory.
Okay, so let's map out the board. Who are the winners and losers here?
The winners are the entities facilitating these new structural shifts. So U.S. ethane export terminals, natural gas pipelines. If the plastics industry shifts to natural gas liquids, American infrastructure is the ultimate beneficiary.
And the electric grid, obviously. If millions of delivery trucks are ditching gasoline, they're pulling that energy directly from the grid.
Exactly. So we're talking about a sustained demand cycle for copper, aluminum, and battery tech. Also, energy importing nations like Japan, Korea, India, they win big here. If China isn't hoarding oil, prices stay low, which helps their economies tremendously.
Right. So the losers then are pretty obvious.
Yeah. OPEC plus, Russia, and those legacy chemical plants in Asia that stubbornly refuse to transition away from oil-based naphtha, they're going to get systematically outpriced.
But there is a warning here, right? This raises an important question about the U.S. infrastructure boom. we have to factor in the geopolitical reality.
We absolutely do.
Currently, the U.S. is under the Trump administration, which obviously has a very aggressive protectionist stance on trade. And this whole U.S. ethane boom relies on free trade with China.
That is the ultimate wild card. If U.S.-China trade conflicts escalate, the Trump administration could slap massive tariffs on these shipments.
Which would artificially destroy the cost advantage of American ethane.
Overnight. It could threaten this entire new business model. So it's a profound political risk that investors must monitor.
Yeah, a tariff could forcefully block the exact elegant solution the free market naturally engineered. Well, this has been a fascinating deep dive. We started with a terrifying headline about 4.6 million missing barrels of oil and tracked it down to refineries losing export licenses, rideshare drivers cutting battery costs, factories swapping recipes to survive a shock, and a nation just becoming a very disciplined shopper.
It really fundamentally changes how we model the future. We aren't witnessing the end of energy consumption. We're watching a highly aggressive evolution of it.
Which leaves us with one final provocative thought for you to consider. If China's oil demand peak is already here, reshaping everything from U.S. ethane pipelines to global copper demand, how quickly will the rest of the developing world, like India or Southeast Asia, follow this exact same playbook? If they leapfrog traditional engines straight to electric, does that potentially make OPEC's optimistic 2050 predictions completely obsolete? It's definitely something to ponder as you navigate your portfolio this week. Don't forget to subscribe and hit that like button.